Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And Ramsey, good to see you.
Always glad to be here.
And we have a almost regular guest, returning guest. Do you want to do the intro here?
Sure. So, Tamiko, I think this is at least your third time here. And, we should do something like on Saturday Night Live, like when you host for 5 times, you get like a jacket or something like that. So so third time, I think, and counting, right? Delighted to have you back. For those of you who don't know Tamiko Toland, she is the Director of Retirement Markets at CANNEX. CANNEX is a leading provider of data for the insurance, life insurance industry, the annuity industry in particular. And Tamiko's influence is really remarkable. It spans retail and increasingly institutional. And that's what we're going to spend a lot of time talking about today is, a lot of the progress that's going on in, what is probably the biggest opportunity in the guaranteed income space, and the core work that Tamiko, her team, and her affiliates are doing to get us there. So with that, Tamiko, tell us about some of the things that you've been up to lately.
Sure. So before I dive right into the 401k space, I'll mention a couple pieces that came out recently. And one was for Investments and Wealth Monitor. And it's really just about the validity of replacing some or all of the fixed income allocation in retirement with a guaranteed income source. And I say it like that because we did the research based on SPIA, but you can replace other annuities as well. So, but still always annuities, but that this actually improves outcomes, both in terms of income sustainability and actually legacy, which is, I feel like that's sort of the hidden story when it comes to guaranteed income, that we act like it's going to make legacy worse. But anyway, so another piece that I've done recently is for the Journal of Pension Benefits, and it is on the topic of 401k. That's been a huge focus of mine over the last couple of years, and we're very excited to be involved in the Lifetime Income Consortium, where we're really going to be focusing on this topic with a group of member companies. The administrative home for this is Broadridge FI360 Solutions, and we're also working with another friend of the show, Michelle Richter at Fiduciary Insurance Services. And so, happy to talk about any and all of that.
Excellent. 401k has been a really interesting topic over a number of years. Actually, years, Ramsey. Remember, I think we did a podcast way back when, episode number 7, if you want to look, and I think when the Secure Act came out. And you think, okay, 2 years, what's happened? A lot of companies have sort of looked at this opportunity. We see some entrants. I'll leave, Ramsey, you can sort of talk about the industry landscape. But just in the last, 2 days, I've had some real interesting inbounds, Tamiko. One was, a writer for Forbes, Chris Caruso, saying, looking for people's answers to a question of, what will really make this sales happen in the 401k space? I'll talk to you about some other questions again, but let's just kind of throw that out. What will or what won't make annuities and 401ks work? I don't know which way you want to take it. Ramsey, I don't know.
Well, I'm taking notes because, as you mentioned, this is an area of primary focus for me and my company, and I have some theories, and I'm very interested to hear Tamiko's input to give you some idea about at least what we've tabulated in terms of, I'll call it, deals announced, right? And they're in various stages of actual execution, but we recently added up, everything we could find in the press, and there's something like, call it $60 billion worth of announcements, that are in the space. So that's not huge given the $7 trillion opportunity, but it's not insignificant. And my guess is it will continue to grow. But how we get there, that's what Tamiko is going to share with us.
Yeah,
so
maybe Tamiko.
What do you think?
Yeah, start with what won't. I don't know. I'm fascinated to get your impression.
Well, I'm going to take a step back about a decade. In 2012, I actually wrote a report on in-plan guarantees when I was at Strategic Insight, because it was a very hot topic and it was about to explode, right? We all felt like this is necessary, it's beneficial to participants, right? In particular, like that's where a lot of the conversation focuses. And there were a lot of different companies that were coming out with initiatives that were going to make a big difference. And they were really designing around the challenges. And, you know, the big one at that time was AllianceBernstein and the Lifetime Income Strategy, which they actually did get placed as a QDIA. And I'll explain the acronym of that as a Qualified Default Investment Alternative, right? And so this is...
Wow, that was great branding. Qualified Default. Wow. Okay, sorry.
Well, it is because it's the default.
Yes.
Right? And this has everything to do with all the money in motion within 401k plans. I mean, the target date fund has become the mainstay, and it is because of their use as a QDIA, right? And all these things are completely related. But it's funny because, you know, at the time, I did this research. It was more qualitative research where I talked to folks who were involved and collected information about the different solutions that were out there and so forth. And I said, okay, well, you know, this is foundational, and then we're going to be, you know, going up from here. And then it just seemed to stall out. And despite the efforts with AllianceBernstein and their success with the UTC plan, which is now part of Raytheon, so people refer to it as Raytheon because they did implement it. And it's been very successful as such. They've continued it. And full disclosure, they are a client of ours. So, you know, so what's happened in the last decade? Why hasn't it taken off? And I think there are probably 1,000 different smaller reasons. And that was one of the facts that led me to believe that the Secure Act alone wasn't going to change the story. And we really pin a lot of the changes on the Secure Act. And I do think it's helpful, and it's certainly beneficial. But the reality is that there are a lot of other like through lines in the industry that are coming together. And I kind of want to get to why is it that plan sponsors really need to consider adoption of lifetime income, because the ultimate reason is not altruistic. You know, companies don't have this paternalistic attitude in general. Like, we need to take care of people. Obviously, we know the trend that pensions are dissipating and they're being replaced by DC. So naturally, we need to include some kind of income solution as part of that. So why hasn't it happened? Why is it going to suddenly happen? I mean, frankly, in terms of the economic environment, when people are facing uncertainty, and, you know, I really do think that low interest rates have influenced this. This is not something we really talk about a lot. But the methods that we use to generate income in retirement, regardless of where you're sitting, have really deteriorated. Bond ladders don't have the power that they used to. So now we're talking about all this as moving attitudes in the retail arena. Well, the same really applies. It's the same people, right? It's just regular American workers who are saving. And when they approach retirement, when they reach retirement age, and they do not have the confidence to retire, then they're much more likely to stay at their companies. And frankly, this is a workforce management issue for companies that want to be able to hire younger workers, promote them through. You can't promote people when there's folks already sitting in those positions. So that company life cycle really gets stalled when you have people not retiring, right? And when you have folks that are hanging on, not because they're passionate about their work and want to continue working retirement, which is a very valid thing that we talk about so much more now with, you know, a revision of how we view retirement. But when that's not the reason people are sticking to their jobs, you know, I think there are a lot of additional workforce issues, and older workers are more expensive to companies. And, we don't want to talk about this. And I don't want to make sure that I'm being careful not to speak about this from an ageist perspective, because I'm also like leaning that direction, as we all are. Time moves in one direction for all of us. But you really want people to be able to enjoy the retirements that they've been saving for. But when you're not giving them that confidence and you're not giving them lifetime income, then that isn't going to happen. I haven't answered your question, but I see Ramsey taking notes, and I have a feeling there might be some more questions flying my way. So we'll get there.
So yes, I was going to say that is the politest version of "Okay, Boomer" I've ever heard. But let me ask you about this. So, do you get the sense that companies, HR departments, the folks that are sort of actually dealing with this particular problem you're saying this can potentially address, do you think they see that yet? Yeah, I mean, is that I'm because at the end of the day, in order for this to work, there have to be pain points, right? There have to be sort of pain points that people are determined to sort of resolve. And so the question is that a big enough pain point yet, you think?
I think that it's a combination of factors. And yes, I do think that the employers are starting to recognize this issue. And I think, and don't forget, there's also like there's the carrot, not just the stick. That's,
Sure.
Of trying to attract, new employees. But, a lot of times that's what we talk about, right? Oh, participants really want this. But participants wanting it isn't necessarily enough to get over the barrier of, oh, there's risk for the sponsor. And that has been where a lot of the conversations have really revolved around. And so it's some, like I said, it's a set of factors. And one of them is lowering the barrier from a risk perspective, which Secure Act does actually remove that in terms of including a safe harbor for selection of the insurer. But there's still a big gap for implementation. And it is a very significant gap, which is how do you actually make the choice? And we know that there are sort of tried and true methods for other investments, target date funds, right? Like, yes, we understand how other investment options, make it into a plan. But we're talking about something that's not just another investment. Income is a completely different conversation, and it works differently. It affects the dynamics, and particularly because you're talking about post-retirement, right? That's really where it kicks in. So how does it behave before retirement? Do we have the same expectations that we do for other investments? And so it's a different mindset. And so when you ask me, like, what is the biggest challenge? We have been working on a lot of the solutions that are necessary. For example, middleware solutions, which are really important for kind of like the connective tissue, all right, for, getting everybody hooked up to this, right? And that market has matured significantly in the last decade, right? We're seeing some very positive change, right? But the reality is that for the folks who are actually considering these solutions, income is not their native language. And I think that is a huge hurdle in terms of getting let's say the consultants, retirement plan advisors comfortable with making those recommendations and confident that they are doing that appropriately for the sponsor client, right? And the sponsors have to feel like, yeah, that makes sense, and I don't think I just stuck my neck out in order to do this. And it's not simply a matter of a legislative fix, because we don't need another like didactic rule about how to do this. And frankly, the Department of Labor generally stays away from that. Like, these things kind of evolve, and the general guidelines, yes, but not very specific details. And particularly on a novel subject matter and a novel product dynamic, which is what income represents.
So, okay, when a two-part question. When I think Tamiko, of the group market, I think, like you mentioned, a company with a very big company, right? If you're marketing products or retirement plans into a large company, the needs start to tier. Like, executive, senior, the super executive management team may have a fee-based only advisory service that helps them do this. You start to go down another tier. These people aren't they've got some big balances, but they're not going to have an advisor. You get down farther in the company, where I think I heard you talking or speaking to, are people who are, they're just trying to pay the bills. Oh, and by the way, I did have a 401k. How do you see the segmentation, the drivers of adoption being, or should they be different based on your income inside a company?
So the thing is that the mindset or thinking around this is that the QDIA is the place where the assets fall, because that is the default flows into the QDIA, and that now has become target date funds, right? And so it's the same thing of how we think about income. Now, I'm going to be honest with you, like, rich people are fine. Right? There's always somebody who's willing to give them advice. They have lots of access to advice. But the people who truly benefit within a retirement plan are those individuals who otherwise have no access to advice or guidance or anything. Right? And so the default, all this entire structure that we're talking about is really, it's designed to help those individuals who are much more on the margins. And if you have outside advice and your advice is, no, we have this different plan, you don't need this, we'll put your money into something else, that's completely fine. And that is how the QDIA is structured. It's a default. It's not like you're not forced to stay in it, right? But it needs to be a quality solution for those individuals who may not be accumulating as much money in during their working years for retirement, and who probably aren't going to get other guidance, right? And so this is exactly why so many people are passionate about this. That it's not, yes, I mean it's great, like that from an asset gathering standpoint, whatever, servicing all these people, but you get folks like me who care deeply about it, because you see, this is a fantastic way to reach so many Americans in a way that the retail space is not going to.
So, okay, this is very, interesting element of it, because we live in a world where the same three, the ESG acronym comes up a lot. It comes up in investing. It comes up certainly in board work. I can tell you, it comes up in a lot of different places. Like ESG is on the tip of everybody's tongues, because it's important in every aspect of business now. And one sort of sleeve of ESG that's often talked about is banking to the unbanked. And here we're talking about, I don't have as neat a catchphrase as that, but it's sort of it is retirement income to the unincomed, for lack of a better way to describe it. But I very rarely heard it, one, described as an ESG issue, and two, I don't really think I've heard any of the current proponents of the space, describing it that way as opportunistically as everybody else is using that acronym everywhere else in the business world. So, wondering what your thoughts on there. Is that a missed opportunity? Because I think it's real.
I'm not sure. I mean, I think that I certainly have heard other people talk about it. I'm not the only one who has articulated it like that.
Yeah.
So I think there are other voices out there saying the same thing. And I definitely see that passion among other stakeholders. Is this the marketing opportunity? I don't know, because ultimately when you look at the dynamics of how these solutions are going to be placed, and the mechanical factors, the choices that sponsors need to make, I don't think that that's the thing. But I do think that drives really, the legislative components, right? And the fact that and the regulatory piece, saying we want to make this easier, we want it to be safe. So it's balancing those interests out, because you want to increase access to all these Americans, which is, that's a very good goal for our government and, folks working there to be thinking about. And they also want to make sure that it's done responsibly. So, I think that may be a more relevant conversation there, and it's a little bit different. Because, like I say, when it comes to building these QDIA solutions, this is a different way of thinking about income than we're really accustomed to in retail, because, when you have an individual client and you know what their needs are, then you make selections that are really much more optimized for, what their goals are. Right. And so you can use these, products that are, as we all know, like so much of the annuity industry has become highly specialized. You have, this benefit that's torqued one way and another benefit that's torqued another way, and they're different use cases. Right. And that's to the benefit of the end client of making it more focused. Right. And that doesn't apply, right, so much when you think about QDIA. You're not necessarily having a single-minded goal. Like, you're not trying to maximize income for every single person. You have to balance out those interests, because some people are going to end up at retirement not selecting that benefit, despite the fact that they've paid into it. Whether it's a decision made out of ignorance, or they got diagnosed with a terrible cancer right before they retired, and they have different goals for their post-working years. There are... It is just a different problem to solve, right, than looking at it as, client A.
Yeah. So
and fitting solutions to that.
Okay. So here's you are in command of you're running the HR benefits for a Target. I just take a job as somebody working in one of the stores. I'm an assistant manager of a store. How should the onboarding experience be when I fill out the application, come to the point of, okay, set up your paycheck? How much, Paul, do you want to put into your 401k? Oh, here's the match. How would you change that setup for me to start putting money in there? Do I have a choice? Is there a default? If you don't say this, Paul, you will get X percent of your savings in the 401k, and X percent is going to default into this income benefit.
Well, that's the idea behind defaulting, is that you don't have to convince Paul to sign up, that you don't need to get educated about the benefits of contributing to your 401k. The money goes in there, you get your match, and then you're put into something that's suitable for you, right? And so conceptually, yes, those are all components of why we're thinking so strongly about QDIA, and not simply having sort of the availability of options before or at retirement. That's part of what the industry calls the retirement tier, right? Which is a range of different options to suit different needs, right? But a lot of that is elective and not defaulted. It's interesting. I was at the DECIA Innovation Forum, and somebody was presenting information about engagement with plans, and that defaulting is great for getting people into the plan, but people don't engage with their plans as much when they're simply defaulted, right? And so there's kind of a tension between these facts, because you want people to understand what they're in and to perhaps decide to increase their allocation, right? And so this is actually kind of a whole other conversation around participant engagement that would also be beneficial and also enhance this, because, frankly, people aren't they're used to the idea of receiving income from their employer through a pension, but they're not used to this as part of the 401k, because it's not a standard part of the landscape. Frankly, relatively few plans even offer it on the outbound, when you retire. But I want to add one other thing, that there's another trend right now for more sponsors to want to keep retiree assets in plan, and designing these solutions also serves that interest. Some designs they may roll out, but a lot of them you're keeping if not all the assets, a bulk of them inside the plan. So.
Right.
So,
I mean, and sorry, just one follow-up on that. Tamiko, my experience has been it is so hard to change a form from an insurance company or a 401k provider. Do you have models of sort of best language for introducing that income conversation? Because 401k, okay, everybody kind of understands 401k. Well, how old is Paul Tyler? If I'm 21, gee, maybe I'm defaulting in here, but I should sort of maybe I take it down. Maybe I'm actually in my 50s. Maybe I should allocate that initially more. I mean, do you have models that say this is the language that should be there so Paul makes the best optimal decision when I set it up?
Yeah, it's a good question. And there aren't models for it. I mean, the only model is, I would say the largest plan out there. If you look at Raytheon's participant communications, they do an excellent job of showing different personas of different folks who would want to stay in the plan or in that guaranteed income option or not, right? But I think part of the understanding of this is that there are also different models of how they work and at what point you are accumulating that future income. And so much of that really ultimately comes down to how the solution works. But for the most part, there's an idea that at a certain age, you have a glide path into income, just like you would have a glide path with a regular target date fund. And so that's how a lot of them actually work. So it's, when you think about the range of different participants and their ages, it may be completely irrelevant if you're 30 because you're not going to be investing in it yet. You're not going to be accumulating that future income. Yet knowing that is something that will happen in the future can be quite reassuring to employees, and it would be potentially an inducement to stay at a company if you were considering going somewhere else. So I could see, again, this goes more to the participants like the idea of income mindset, as opposed to this is beneficial for the sponsors. It's beneficial for everybody, frankly.
So I wanted to pick up on what you were saying about staying in plan, and this is something that's been of particular interest to me, and I want to hear what you think about what the potential implications are. Well, first of all, what is the motivation? Let's start with the motivation for plan sponsors wanting to keep people in plan, not just into retirement but through retirement. Then the second thing is would be, what are the implications and requirements for them, and how that might be different than what they've done in the past. So let's first start with the motivation. Like, why do you think a plan sponsor would not want to just wash their hands of the retiree once they leave the company? Like, why are we now in a world where maybe they want to keep people in plan for longer?
Well, I think they're recognizing the advantages of scale, right? You keep more folks in your plan, you have larger assets, and then you're able to drive down costs. I mean, that's a pretty basic dynamic from a pricing perspective. And like I say, there's blended models and what have you in terms of what happens with the actual income component. And I think there are much more subtle conversations and probably differences among different types of sponsors. I think the traditional mindset has really been this participant isn't a worker here anymore, so we want to kind of sever that responsibility because it is a fiduciary relationship. But there are advantages too, frankly, for the worker. Right? That, because it is a fiduciary relationship, and, you may be able to take advantage of things you're not going to get elsewhere. So sorry, I want to just follow up on this, Paul. So I'm with you, and I agree. It's part and parcel why this is an attractive opportunity for plan sponsors and frankly for asset managers and carriers. The one question though was, so at that point of transition, so you are a fiduciary and you now want somebody to stay in plan, after age 65, but now this person
in theory, can go a lot of other places, right? They can roll over and go to, any number of sort of established, asset manager sort of providers or broker-dealer providers who have these entire suites of services. And so in some sense, you're telling the person, well, you should stay here with what we offer, this service offering we have, which may or may not be as expansive as all the other things that they might do. Like, is there a fiduciary responsibility there that is also quite different? Like literally at the point of transition, and not just managing, but basically saying please stay as opposed to going.
Yeah, and I don't know that the rhetoric is you should stay. Right? Yeah. I think the rhetoric is much more, hey, this is the benefit that you've accumulated, and then you can make your own decision whether that's with some degree of guidance, or if that's independent of that, and there's just information that's conveyed. I mean, there are a lot of different models of how to do that, but I think the premise that you should say because we might want to keep your assets in plan is probably not the way that I would think about it. And also, the rollover situation right now is in flux. And so the relative ease with which that can happen is like that. I think that's at question. So there's more reason for the sponsors to be offering like good options within their plans, right? And we'll see how things evolve. It's just going to say, adoption's not quick, and that's the reality.
Yeah, it's
just hard to figure out whether the new rollover rules create more problems for the people that are trying to be rolled over into, right? Or if they also create similar challenges for somebody that says don't roll out, right? I know that these are open issues, but it's the complexity. The complexity is striking to me.
Yeah, I think for our listeners who are independent agents or advisors, the plus is the employers have started that income conversation, Tamiko, in a way that they at least start to understand. They all understood asset allocation. Now they're starting to understand income. And Ramsey, you brought up a really good question, which is, wow, this would be really difficult to roll over. We already have some rules from the DOL, coming into making it very difficult to do this properly. But now you've got a little bit of tension, with some of the plan providers and where that money's going.
I think that would be more true if we had current wider adoption of lifetime income within plans, and it's just that it's not significant, right? We need to see more of it, and the cycle of getting things adopted is very different from simply selling somebody an annuity in the retail space, right? So I don't see that as being a present issue, and we don't know actually what will ultimately happen as far as rollovers out of plans. So we can speculate all we want about that. I think that a lot of this conversation, frankly, and I've said this the whole time, and with the lifetime income illustrations that are going to be appearing on people's 401ks statements, that's all of an opportunity for retail, right? Because when you see, my 401k could turn into this guaranteed income, yet there's literally no way to possibly do that within my existing plan, right? So when you run into this logistical challenge, but you start thinking about what to do with your retirement savings in a different way, like I say, I think that is a great opportunity in the face of some potential compliance challenges, right? So there's a lot of forces at play right now, for sure.
Now, there are a large number of big plans like you described, like Raytheon, with good HR benefits, professionals, tremendous support from advisors for the plan. But there are like a lot more small plans with fewer participants. Tamiko, do you think the equation or how sponsors are going to think about it will change when you start to go down and maybe you only have 10 employees, maybe you have 15 employees? Do you think the adoption challenge will be any different, or it'll be just effectively the same set of considerations.
Well, I think, really what's going to happen is we're going to see an increase in adoption, right? It is going to happen for sure. It is happening right now. But it's as that picks up, I think it will make it more of a competitive issue then it shifts to making it a competitive issue for employers, right? In addition to all the other reasons that people should be, or, plan sponsors should be considering it. And I think we'll see more solutions that are particularly tailored for that market, right? So, some of them are really designed more for the larger plans for, I think, obvious reasons. And we've seen availability for smaller plans, but then adoption is low because they're not necessarily they may include it in the plan, but it's not the QDIA. And so that's like the big shift, I think, for everyone. And whether that's an appropriate choice for a small sponsor, that's a different question. I mean, I'm not saying it is or isn't, but I think that's a thing to think about. When you have very few employees, you're going to be thinking about their needs really differently and much more for those individuals. And, then let's think about PEPs and what have you. But, like I say, it's a different set of considerations in this space and that learning curve, which is one of the reasons that, we really wanted to see the Lifetime Income Consortium come together, because we can get the education out there. It's a large group of very, very different solution providers that are, really deciding that it's more important for them to work in concert, to get the message out, to improve education, and to reduce some of the compliance hurdles.
So how do you think about, the mandate of this new organization versus, there are some other educational organizations in the space, right?
Yeah.
There's the Alliance for Lifetime Income. There's Limber Loma, all friends of the show, by the way.
Yeah.
Curious how you view the mandate of this consortium as being different, or what's the sort of unique, element that you guys are focusing on? Is it the complete focus on this one particular space? Is there anything else about it stylistically that's part of your MO that you can share with us?
Sure. I think, we're also very friendly with the other organizations out there. And yes, education is a component of what we're doing, but we're not an educational organization. We're actually, our goal is commercial. And commercially, we want to see broader adoption of these solutions. And so it's a commercial look at the problem, not simply throwing out education, but education saying, okay, well, what are the challenges? How can we help close those gaps? And then, where are there actual logistical adoption issues? Like, say, with the record keepers, right? Because the record keepers are the ones that, frankly, are holding the keys on this, ultimately, right? And, they are not jumping into the pool, right? And so, that is, it's a concern that we're all listening to, and we just want to make sure that all the dots are lining up to make this a reality. And we want to hear from the folks that are really in the front lines and hearing the objections, dealing with those challenges to help solve those challenges. So, we're just in year one, right, of the consortium. So we're just establishing really the basics, and then that work will continue. And one of the issues too is how do you compare these different solutions, and how do you make a selection? And that's something that we're working on from an analytical perspective, right? That saying, well, what kind of quantitative support is there? The conclusion is never there's one best solution, right? There are solutions that work differently in different ways. And what's very important is for people to have some quantitative basis to say, well, this is better in this regard, but this one's better in this regard, and what works best for our, worker population. And that's the kind of decision making that we really want to support at CANNEX.
Okay, so here's literally $1 million question. Just to set it up, I was at an InsurTech conference here Monday. Ramsey, we actually had former guests there at this event in New York. So Jerry Golden was there. Spent some time with Jerry. Yeah. Our friends from AM Best TV was broadcasting there. You were missed. actually people came up and talked to us about our show, so we're crossing a lot of wires here. But Tamiko, we took out some very prominent VCs for dinner the night before, and question I got was, yeah, I'm reading about this and hearing about this, Paul, but like, when when is this going to be a meaningful market? Is it 3 years, 5 years, 10 years from now to invest? I mean, what's your perspective? When will this be a material enough business that people are going to fund a lot of the businesses that are making big bets in this space?
So it's a slow play still, honestly. Like, it's not like all of a sudden everybody's going to start throwing this on their plans. And my feeling is and I think this gets missed a little bit with like the Ramsey's press release survey, right? A lot of the companies that are really engaged now have been engaged for a very long time, right? And they feel like this is an important opportunity, right? But when you've been doing it for a decade or perhaps longer and not quite nailed it, I mean, there's a lot of conviction around the space and being present and planting the flag, where I don't think the expectation is, oh yeah, we're going to be getting our money back in the next year or two, right? So I think at a high level, firms decide this is where we want to be, right? And if you need to like replenish the coffers quickly, I think it's still going to be tough, because it's still very, very difficult to predict. And history tells us that this is not a really fast moving space, right? But I mean, I think the opportunity is obviously still there, and we're getting so close. Like, it feels like we're really on the cusp, but on the cusp of something that's still relatively slow moving, right? And especially large sponsors want to see what the other ones are doing. Like, what choices are you making? How are you implementing this? How did that go? Right? And I think that experience feeds into the willingness of others to jump into it, because it's not simply about saying, oh, great, we're going to pick this thing.
Ramsey,
all right,
we're kind of at the top of the hour here. I don't know. Final thoughts, questions here?
Yeah, so much to chew on there. I was really struck by your comment about sort of the culture here, the culture of the target audience. And if you think about there's two target audiences, right? The first one is the plan sponsors, the folks that are holding the that have the assets. And then the ultimate target, obviously, is the end consumer. But you pointed out quite rightly so that you have all the people that are in a decision-making position don't necessarily have a culture of talking about income at maybe the depth that it needs to be for them to be comfortable to move forward with things like this. So it'll be it's just an interesting conundrum to figure out how to get past that point. Is it the same people getting educated? Is it new people in those roles? I don't know. But that is of the many interesting things you said, that's the one that sticks with me, because I feel like that's often the hardest thing to overcome.
But it's an opportunity as well for the intermediaries,
sure.
Right? And let's not let that point get lost, right? Because when you talk to folks about like target date funds, and people who missed the bus really missed the bus on that. So I think that the same goes for income, and even if you have not been a passionate advocate of income solutions, right? I think now is a really good time to learn about them, and how does this really apply to the workplace savings, right? And it is different, and there are different ways of thinking about it, and there are different ways of breaking down the client, because the client is this. Or the end user is the sponsor, right? But it's funny because there's a parallel between retail and how we think about, who's the client? Well, is the client the person who ends up with the annuity, or is the client actually the financial intermediary who ends up making that recommendation? And we know that the industry has always seen it as that financial intermediary, right? And the same kind of goes here. but they're providing advice, and they may be providing other fiduciary services as well, where it's very relevant for them to need to be educated to a higher degree. You're certainly not going to be like seeing people change seats in HR departments or CFOs change because of income. Okay. So we got to work with what we got here, Ramsey.
No, this is terrific. I guess for the listeners who are hungry to learn more or want to follow you, what's the best way? Is it LinkedIn? Is it your corporate website?
LinkedIn is great. I mean, CANNEX is active on LinkedIn. I'm active on LinkedIn. We are also on Twitter. If you're interested in any of the research and articles, commentary, and what have you, also our website has a wealth of information under thought leadership, as well as videos and all kinds of stuff. And there is some stuff on lifetime income there as well. So
excellent. All right, listen. Thanks.
There's a lot of stuff on lifetime income.
There's a
not
lot.
Some.
Well, yeah.
There's a lot, and we will put those links. We will put those links in the show notes if you want to click in and connect or visit the website. So, Tamiko, thanks so much, Ramsey, as usual. Appreciate all the great questions and thought behind this show. Please join us again next week and for another very interesting episode of That Annuity Show.